Welcome, everybody. I'm Mark Peter Davis, managing partner of Interplay. I'm on a mission to help entrepreneurs advance society, and this podcast is definitively part of that effort. Today, we've got a end of year 2025 prediction recap. So we'll hear Mike and Phuong's predictions from last year and see how they did. And we're going to hear their predictions for 2026. Now, if you haven't been following Interplay for that long, Mike leads our venture investing side and Phuong leads our accelerator. So they've got really good insights that are super tapped into the early stage market. Mike more focused on seed, Series A. Phuong focused more on pre-seed and seed. So we're going to hear their perspectives, what's going on, the challenges faced by those companies by stage. And I think it's super insightful. So I hope you enjoy. We're also going to take a break after this session, coming up on the holidays at the end of 25. And we'll be back in the flow in January. Thanks for listening. Welcome, Mikey.
Hey.
This is your first time in the podcast studio.
Yeah, we're a little close for comfort.
Yeah?
Yeah.
Hey, you were complaining a minute ago about the stage alignment here.
Yeah.
How are you feeling about it? Can it work or?
You know, I have comments, but per usual, I'll keep them to myself.
That's not per usual. That's only per usual on a podcast.
If you know me, I keep my comments to myself. I'm not very direct, or I don't tend to share what I think.
Okay, good. Yeah, that sounds about wrong. All right, let's jump into this. So last year you made a slate of predictions.
Yeah.
And I think you kind of crushed it. It's not like everything's dead on, but like pretty good. Let's run through them. So first is on the jobs front. Mm-hmm. You said something to the effect of some white collar jobs will start to be supplemented by AI, but they will not be totally conquered by AI. Mm-hmm. How did that one work out?
I mean, it seems to be playing out exactly in that way, especially for the white collar. I think even for the blue collar jobs, you're seeing little replacement, honestly, much more supplementation. And I think, you know, I don't know how that will play out. I'm more skeptical there that it will be pure supplementation. But I do think the overall trend of AI to augment has been much more in line than AI replace. And I think in this first phase of whatever we're calling AI today, that seems to be the trend and what we're going to see going forward. And I feel pretty confident about that going for at least in the next 2 to 4 year stage.
This feels like seeing the amount of change that happened based on the kind of AI thread. If you were to draw out this line, I think we're kind of in the first inning.
Oh yeah,
it just started, and this is not where it's going. When I hear people talking about job supplementation versus replacement, I think of that more as some people might be softening the blow of what's coming, but it's going to be a transition, and there certainly will be more disruption. So do you think the supplementation, there's been some displacement too. We've seen a bunch of companies come through that are taking some people out of seats because you don't need as many people if you can use the software.
Yeah,
so
I think that's louder news headlines than the reality.
Okay.
I do think it's happening, and I think more likely people are just not hiring as many people as they need to. But I mean, even look at big companies like OpenAI is hiring thousands of people. These companies are hiring up for this, and if they're the
there's a bit of irony in that.
Yeah, if they're the leading educator now, of course, is OpenAI doing more revenue and they're a bigger company than anyone's ever done with the amount of employees that they have, probably true also. But the point is, it's not like they're going to be a 50-person company doing $100 billion a year of revenue. It's still going to require a lot of human power.
Eventually, for that to happen, AI would have to build the AI.
Yeah, and that's probably coming, to be fair. But I do think you still need to figure out things like distribution, community, getting people to use the product and work with them in some sort of customer service angle of this. I think the software component and the build component can become as commoditized as you want it to be. But in some respect, you're still going to have to go out and get people to use the product. And I mean, we see OpenAI's advertising now. There's advertising teams, there's engineering teams, there's customer service teams. You still need these core components. And again, back to my previous point, I think AI is probably internally at OpenAI, to keep using them as the example, helping all of these teams with all of these functions. And we're seeing that at our portfolio companies as well. Now, instead of needing 100,000 people, maybe they can do this with 10,000 people, but it's not 0 people. And I don't think that trend line's really shifting anytime soon.
Now, you said on valuations,
yeah,
that the Hype companies and, not the same, the foundational AI companies will continue to have high valuations in 25.
Yeah.
And then outside of that, the broader market you thought was kind of normalizing.
Mm-hmm.
How did that stand up looking back on 25?
Yeah, I feel pretty good about that one too. I mean, we've seen OpenAI go to, I think they've raised 3 rounds this year, pretty much doubling every time. There's a pretty clear line of sight to $1 trillion valuation for them. All the other foundational model companies have similarly scaled. Even the big existing public tech companies like Google, their market cap has grown quite substantially this year as well. So I wouldn't rule them out of this like AI growth cycle. Like they are the biggest players in the space. So I think did really well there. How long that lasts, sort of TBD. I mean, we've seen rumors of Anthropic going public. I think if they go public, OpenAI will be not very far behind them. At the end of the day, they need more capital, and the public markets are probably still the deepest capital pool. So that trend, I think, doesn't stop anytime soon. There's still way more demand for tokens than there is supply of tokens right now. And I think, again, I don't see that trend changing in this 2026 calendar year. 2027, 2028, I think is sort of TBD. My view is like at some point, these models will start to asymptote. At that point, then using the 1 or 2 models before will look not very different than using the frontier models. You'll have special frontier models for special use cases that might be worth paying for, but the general pool will not be needing to use the Ferrari to get to work every day, right? You'll be totally fine to get in your Toyota Corolla. It will do 99.9% of things your Ferrari can do and get you there safely on time and do all the things you want. And it will cost 1/5 the amount or 1/10 the amount or 1/1000th of the amount. I think that's sort of to be due. So we reach that point, then I think the question then poses like, do you need a lot more tokens or are the models way more efficient than they are right now? It's still that's bucket that one for next year's conversation, but I do think that's beginning to emerge on the horizon at least. Again, whether it's 2 years out or 5 years out, I think is TBD.
So the trend line here is big tech eventually kind of going beyond.
Yeah,
a little out. Big tech merges with, the foundational models merge with or become big tech.
Yes.
And in a parallel a little bit to what we saw happen with cloud compute, where all the big tech have their own platforms for this, it does start to commoditize after you get up the innovation curve. And, when it commoditizes, a lot of the value then is accreted to the application layer.
Yeah. I think cloud is the closest analogy we have to this, where at the end of the day, people will probably want 1 or 2 providers, maybe 3 providers, maybe more. And they're going to use different models or different clouds for slightly different specialized use cases, or they just want diversity.
So there'll be some consolidation in this market.
There'll certainly be some consolidation. I think, I don't think Apple's going to be a non-player in the space forever. They have a lot of cash. So what do? They probably buy somebody.
They're going to buy one.
Who knows? But there will be some consolidation. You'll sort of shake to a 1, 2, 3 player ecosystem is my guess. And then you'll have a long tail of models, by the way, that will work really well for a bunch of use cases, and they might be really cheap or even free open source models. But most, I'd say, consumers will operate on one of the kind of core 3 models and let them manage it and update it, and you can just sort of be on the frontier.
So now your third prediction was that the IPO market would be better than 2024.
Yeah.
But it wouldn't be a 0 out of 10 like 2024 was. It would be a 4 out of 10.
Mm-hmm.
So, not a great market, but in motion.
Yeah. Well, let me skip back 1 second, then we'll come there, because the other thing to talk about was the rest of the venture market. So the non-AI portion of the market, which I do think is important to hit on, because I think we nailed that one. So the traditional SaaS businesses, so the non-AI hyperscalers, that market is growing nicely. And
this is the application layer we're talking about versus the infrastructure layer, more or less, if you had to simplify the lines in the sand.
Yes, I think it's the application layer. And I think sort of what you want to call the application layer today is sort of up for grabs, in my opinion.
Yeah.
Now, is it just AI application layer companies, or do existing software businesses that now use AI in their platform fall into what we're calling like this application layer AI world or not? I think if you look at some of our like traditional vertical SaaS portfolio companies that now have a bunch of AI tools embedded in the platform, are they an application layer AI business, or are they a traditional software business?
This is, my take on this. Yeah. Like, this is just like mobile. We saw mobile companies come out way back when, 2006, 2008. And we'd be looking at these companies and, it's a mobile company, mobile first. And then every tech company had a mobile layer. You just had to. So I just think AI is going to blend into general software bucket.
Right.
I think it's probably already done that at some level. Everything has AI in it that we're looking at, right? Some are things that wouldn't have existed before the AI revolution, but you're hard pressed to find a really cutting edge, forward thinking software company that's not leveraging AI at some level.
Totally agree. So in that market, we're aligned. And I think those businesses, there's still like a lot of growth in good companies. Those businesses are not trading at nearly the same multiples that the foundational model companies are trading at. And some of them are growing really fast, and some of them are growing at sort of like more normalized, triple, double SaaS numbers.
Right.
And I think both of them can build really good businesses. The ones that are ironically probably growing slower are building more durable businesses, and the ones that are growing faster have a higher growth rate, but the durability is a bit more questionable, as you see a lot of people sort of still trying to figure out, oh, do I need this? Should I try this? Oh, I'll buy it. And then they churn out. So I think those markets are still sort of humming along.
So I think people, though, who maybe are a little less close to this market that are exclusively reading some of the tech pubs, they're reading about most of the hype deals. Right. There is a small percentage of this market that has crazy valuations that are happening overnight. And then there's a lot of other companies where the valuations look a lot more like traditional venture valuations. Do you see any correlation with quality between those two stories? Is that the right, are we thinking about the right way? It's like 5% of the companies are getting these crazy valuations.
Yeah, it's 5%, but it might be 50% of the money. So it in terms of size of company pool, small. In terms of dollar amounts, large, and disproportionately large probably. I haven't broken out the numbers personally, but it's clear, when you see some of these rounds at multi-billion-dollar rounds, like that's a lot of $20 million Series A's.
Yeah, there was a $5 billion seed round announced this week.
Yeah, it doesn't, and so it.
Where do you think investors are going to make money?
It's a tough one. I think you can make money anywhere in the stack right now. I think some of them need to be more momentum trades. So I think some of these AI model businesses, you're much better suited if you can get in now knowing that they're going to go raise more capital in 6 months and knowing the market's going to price them higher and saying to yourself, okay, I'll be in this trade for 2 or 3 years and I'm going to try to get out.
But I want to I want to categorize this market in a couple segments to make it really clear. And you and I are both thinking this way, but some people on the outside know it. You've got the AI foundational models. These are effectively, even if they might be young companies, these are the future big tech. They're going to be part of big tech, right? They get acquired or they're owned by Google or Apple. They're huge CapEx intensive plays.
Yep.
They're kind of in a different part of the market than everything else. And in the everything else, which is not exclusively application layer, but tends to look a lot more like application layer, right? You've got a distribution of outcomes, and there's kind of two markets there. There's the companies that are popping, and they're getting really huge valuations. They're garnering a lot of capital very quickly, justified or not. And then there's companies that look more like traditional venture valuations. And, they're maybe those companies are worse or better depending on how you pick within each of those buckets. But there's, in this application layer, there is a tale of two markets.
Totally.
At least by valuation.
Yeah, I think to go even more granular for you, you have the first bucket is these AI first, either, some people call them ChatGPT wrapper businesses or whatever. But I think it's, at the end of the day, like they're AI first solutions. Like Harvey's a really good example, right? Just raised at, I think, $8 billion valuation. Rumors are something around $300-400 million of revenue. I don't know the exact numbers, but you call it like pretty high multiple business for where they are and sort of the stage of they've only been around for a few years. And then you have more traditional software businesses that might be doing 20 million, raising at $200 or $300 million valuations. And I think, the growth rate on those might look a little bit different. And I think the investor expectations for what they can do in a market obviously look different. Otherwise they wouldn't be priced so differently. So I think you can probably make money on both trades. I think one is probably you're building for more of a long-term business with realistic exit scenarios. And the other one is probably much more of a momentum trade. And if they happen to define the market or category and become the long-standing one, great.
If not, you got to play a secondary at the right time to
You
get out.
probably need to get yourself out of them at some point or before the valuations come back down to earth. Because if the growth rate slows, even for 1 or 2 quarters, it's going to go from being a 50x multiple business to a 10x multiple business.
Now, let's look forward. Okay. Exit market 2026.
Yeah.
This market's maturing a little bit. It's changing. You've been in VC investing now for a decade.
Yeah.
What are you seeing? What are the trend lines that you see going into 26?
Yeah, I think, we will have more of the same, honestly, from this year. I think we will see a few more mega IPOs in 2026. Whether that's Anthropic, whether that's SpaceX finally going public or some form of it, whether it's OpenAI or going public, I think you'll see some of the mega folks start to access the public markets for capital. And then hopefully that continues to free up more capital and more investor interest in downstream. I think if we were a 4 out of 10 this year, I could see us going to a 5 or a 6 next year. Again, I don't think we go to like a 9 or a 10 or anything that looked like sort of peak COVID or ZERP era stuff where companies were, IPOing sort of daily. But I do think we will continue to move to a more mature market on the IPO side. And I think also as interest rates come down, PE and sort of acquirer, also strategic interest will continue to increase. I do think those companies, if you look at the public markets generally, it's really a tale of two worlds right now. You have high growth tech and you have everybody else, right? They say it's the S&P 500, but it's really like the S&P 493 and 7, right? Because everyone else in there is not growing and the tech companies are growing very, very fast. So how are they going to get growth, right? They're going to have to go buy it.
Right.
So I think the way they do that is you never either use balance sheet or raise outside capital, aka debt, to go buy companies in the space. And I do think you'll start to see more of that.
I also think you touched on something that's an important evolution of the exit environment for the venture ecosystem. If you look at in comparison to the LBO market, a lot of LBO firms, leveraged buyout private equity firms, will buy a company and they'll sell it to another buyout firm. Mm-hmm. And it's a little bit of a game of hot potato, and the firms play at different stages of the market. They're finding ways to create value for their LPs in those trades. But historically, venture has been very different. It's been kind of a two-track story. You build the company, you either get acquired outright by a strategic in most cases, or you go public. The world has changed a little bit as the business models have standardized, and some of these companies haven't been as liquid for too long, mm-hmm. where we are seeing more private equity buyers show up in the venture ecosystem. Yeah. And we're seeing more funds show up that understand the secondary market and are trying to buy LP positions. So the liquidity narrative for venture, it feels entrepreneurial in a sense that Wall Street types, financiers are coming in and creating solutions in the venture market that might candidly be part of the story longer term, even if the IPO market gets crazy again. Yeah. There's just a much more robust, heavier market now that needs more options.
I think to say what you're saying slightly differently is that venture's matured.
Yeah.
Right. It's not the cottage boutique industry that it was 5 or 10 years ago. It is a robust institutional asset class now. And you have a lot more institutional LPs and you have more institutional allocators and you have more funds and the ecosystem is developing around it. And that's sort of what this looks like in terms of secondary funds buying GP stakes, secondary funds buying LP stakes, secondary funds buying direct positions, founder liquidity, early employee liquidity. There are people filling every single gap of the market. And that's what a robust, I think said even more differently, that's what the US is so good at, is building robust financial and capital markets to supplement and help these businesses become successful by providing options to people along the way. Because what happens when you're a company at the late stage and your early employees want to go start something new but don't have any money to do it? Okay, someone shows up with a check and says, hey, you're employee 7 at Anthropic. I'll give you $5 million for half your early shares. Go start a business. Oh, by the way, and I'll give you $5 million to start your new company. And now you get new companies and new growth and new innovation. I think this robust ecosystem is great for innovation. It's great for the US and it's great for the economy generally. And I think it'll lead to a lot more great companies being started. So I think it's a pretty exciting new business model within the venture community.
And it solves kind of, I don't know if it's the last, but seems like the last remaining problem is this return of capital to LP base and creating some more capabilities in the market, closing that loop a little bit, I think will help make it healthier. Yeah,
and I hate to give AI another shout out because I'm so tired of the AI is going to fix this narrative. And we can talk more about this later, but I do think it's funny when you it's sort of like the old adage of like when your taxi driver starts buying, it's time to sell. I think when your grandma starts saying AI is going to fix this, it's like, whoa, is this market getting hot right now? Because it's such an abstract thing and it's not the right person to say it. But you do hear it a lot. And I think there are a lot of businesses, legacy software businesses, let's call them, that like, if with a new fresh set of eyes, if they were to come in and say, hey, like all this can be automated, or we can cut your engineering team in half, you could get these businesses to be quite profitable and interesting. And that's what PE does best. So if you can get good PE firms now to come in and give businesses fresh looks, there's a trade there available again. And I think that trade didn't exist for a long time in tech, but now it's back. And back to your point, it creates a lot of liquidity solutions.
And for the financiers, it's a different cost of capital too, right?
Totally.
So you can just get the companies aligned with outcomes that are more tolerable for that investor base.
100%.
Okay. I'm going to prompt you on a couple rapid fire 2026 predictions.
Hit me.
Okay. Ready for this one? Any of the major LLMs go bankrupt?
No.
No. Okay.
Way too well capitalized and way too much investor demand for them. Do I think that their valuation growth could slow? Yes. And I think too importantly, like I assume when you say major LLMs, you're talking about the upstart sort of, labs. So Anthropic, OpenAI, et cetera. I don't think Google's going bankrupt, right?
Yeah.
But I do think you're starting to see in a very important moment where Gemini sort of leapfrogged OpenAI last week. And you're seeing the early data, right? Gemini's usage is going up, OpenAI is going down. So people are directly moving over to it. So distribution still remains king. And I think you will see struggles from some of these upstart labs as the competitors have caught up or now surpassed them. And it will create a very interesting dynamic for this year going forward.
One of the big strategic nuances we've been navigating on the investing side has been this looming presence and threat that big tech, which I'm going to use broadly now to mean the entrenched players and maybe these new entrant LLMs, have been in a way that seemed at least more aggressive than historically, leaning into building application layer.
Yeah.
And so when we're out investing in a startup that's an application layer company, you always are thinking, is big company X going to compete with me tomorrow? Do you think that's going to continue or slow down in 26?
I think very excitingly for application layer AI investors like us, I think the Google leapfrog of OpenAI created a moment where OpenAI realized that you can't do everything to everyone all at once. And they have sounded the alarm. They are pulling back resources on
You're saying OpenAI is pulling back?
OpenAI is pulling back resources on application layer projects that they were building internally at ChatGPT for consumers. And they are going back to focusing on their core model because they are not best in class anymore. And I think it's the wake-up call that very few companies can do lots of things well. I mean, even the big, let's call them the biggest tech companies. You have big tech and bigger tech companies, right? The bigger tech companies, like Google does a lot of things, does some things really well, and does a lot of things not that well at all, right? You could say similar things about Apple. You could say similar things about Facebook, Meta, and so on down the list. But I think specialization still matters. I mean, Google's best thing is search, right? And a lot of their ancillary products on top of that are fine. And I think if Google ever needed a sound of code red, which they have done before, they go back to their core bread and butter. And I think OpenAI is going to go back to their core bread and butter. And that will continue to open the aperture for companies to build on the application layer, which is the right way for innovation to develop, in my opinion. I think you will get better products and services if entrepreneurs are able to build on the application layer, leveraging the great models that they've built, leveraging the infrastructure, but building it in a way that's sort of like entrepreneurial first and ground up first, as opposed to having a big behemoth allocate some resources towards it. I think in that case, you generally get mediocre products, right? Look at the way Microsoft has bundled products forever. If you want to go use Teams, mediocre product. If you want to use their chat product, super mediocre. Now they bundle it and they create a pricing reason for you to use their product over the markets, but it's never the best product. And I think if we want the best products as consumers and business owners, we should be excited about the application layer building in.
The enterprise. We're kind of entering, I don't know if 26 will really be second inning of AI, but let's call it that for this. What does it look like in terms of enterprise adoption of AI?
Yeah. I mean, I think enterprise adoption has been exceedingly strong for AI versus other cycles. I think the enterprise has been the most fearful that AI could erode their existing business modes, and they've been forced to try a lot of stuff. I don't know if a lot of that try fatigue is wearing off because obviously churn has been high on a lot of these products. But the enterprise is going to need to adopt AI in order to continue to maintain their moats and business stance. And I think like any of these revolutions, like some of them won't do it and they will struggle, and some of them will do it and struggle, and some of them will do it and be successful. So I think it's a broad question, and you'd probably want to go subset by subset to try to figure out which industries you know are the most susceptible for it. But I think a good one is like, look at Salesforce, right? Mark Benioff is still the founder and still the CEO of that business, and he's able to come in and say, hey, like we are going to completely reorient Salesforce towards being agentic first. Like I think I heard a rumor that he's going to rename the company, right? Agentforce from Salesforce, because he feels so strongly that AI will eat their lunch as a legacy CRM player if they don't recalibrate the business and build toward it. That's the extreme version of it, not the enterprise, right? And I think he has a front row seat to this, so it's probably something that's worth watching for other big business leaders. But you know, I think that in that situation, it makes sense.
All right, last question. We talked all software. The AI, let's say it's entering the second inning.
Yeah.
Robotics, it's still in the dugout.
Yeah.
What happens in 26 with robotics?
I think robotics is further away than most people think. Well, I think let's back up and define robotics for a second. I know you have strong opinions on this, so I'd love you to chime in as well. I think when people say like robots are coming, I'm like, they're already here. You get in one every morning to get to work, right? Your car is a robot. Now, it's not a humanoid robot. It doesn't think for itself. Well, Tesla full self-driving does think for itself now. But my point is, we've been building robots for a long time, since the Industrial Revolution. Now, I think this version of the robot is new, and it can be humanoid, and it can have AI embedded in it. And it can probably eventually think. But we've had robotic disruption across our supply chain for a long, long time. And I think we are still, let me finish and go ahead. And we're still, I think, years away from a humanoid robotic disruption and what that could mean for the way we've built our world. But I don't think people should be as afraid of robotic disruption as they are, because we've been doing this for 100 years.
Right. I think you have to understand the real definition of robot.
Yeah.
Because we think robot and we imagine cartoons from childhood.
Yeah, you see iRobot. You see Will Smith fighting robots, right?
But robot means a non-carbon entity, right? There's some software or hardware doing something that a human used to do.
Right.
Answering machines, voicemail, robots.
Totally.
Right. Doorbells, robots. Right. All these things are, right. We
Farm equipment, robots.
They're everywhere.
Everywhere.
But you're right. Let's talk clearly. Humanoid robots, which are different.
Yes.
And the big difference in humanoid robots from all of the robots is they are designed to interface with the entire world around us, because we have built the entire world to interface with us, and they're shaped like us. When you build a coffee machine robot, well, it does one thing. It makes coffee. In theory, a humanoid robot will have the physical capability to do anything that we do. And that's the difference. That's a completely different paradigm of technology. It's this universal robot, one robot that can, in theory, do anything. So the question is, what do we think that's going to do in 26? Because these do exist now.
Yeah.
They're in pilot phase, candidly.
What would you want your humanoid robot to do?
I think where they're going to start is for a consumer, they're going to start in housekeeping.
Okay.
And, it's easy to think they might do gardening, but there are other things like robotic lawnmowers that might still have a place. But any shrub that has a weird shape that you can't make a one-size-fits-all robot for, that's the answer. Obviously, a humanoid will come and solve it.
Yeah.
And then there's it gets really interesting, and we're seeing a lot of opportunities around the application of humanoid robots in physical blue-collar spaces. So not white-collar environments, but construction, those types of worlds. There's a lot of people thinking about how to implement there.
Great. We are super short on construction jobs. I mean, construction labor for open jobs, so I would say. We need a lot of help building. So I'm super bullish.
And that's just to get to the demand that we know of.
Right. There's exponentially more demand if costs come down.
Right. If the cost went down asymptotically to zero.
Yeah. Or
we would restructure so much of the landscape of society.
Also think about what you could do if they could work all night, and they could work quietly, and they could work without injuries, and et cetera,
and it could be thousands of them at once.
And they're supplemented by humans.
Times could be quick.
And any dangerous part of construction, a human doesn't have to go do anymore.
Yeah.
Right. Send a robot in. If it falls, no one cares.
Yeah.
So I I hear you on these things. I do wonder though, if for like construction and a lot of these use cases, first of all, we have a robot for coffee. We have one in our kitchen and it makes me coffee every single morning. I push a button and it brews me a cup of coffee. Again, it doesn't look like a human, but I don't have to do much more than push a button. And I would never pay for a robot to make me coffee when all I currently have to do is push a button. Like those are the things that to me, I think are like a little weird sometimes. Like we already have these robots, but anyway, I digress. I think the humanoid function makes a lot of sense to me. In machinery, like maybe it does for some things, but like if in construction, maybe that's for some things, but also like maybe you want like some cool, like, I don't know, Tetris style robot that can like shift in 360-degree circles and who knows? I don't know. Some entrepreneur will figure that out though, for sure. But I do think like the home nanny robot and those things like are interesting, but probably still a little bit further away than most people think.
Okay. I think this 26, we're going to see the super expensive V1.
Yeah.
That very few people buy. Very low volume of sales.
Yeah.
But there'll be a novelty item out this next year that tech forward, ultra wealthy will be buying, and it won't work as, it won't be the one they want to use later. It'll kind of be like the original Tesla Roadster.
Totally.
Overpriced and doesn't totally deliver, but it's the beginning. It's the beginning of a thread.
Yeah. I agree with you that there will be some of the early adopters on the curve that want to be the ones to own the first home robot. And I think they will spend a ton of money on something that doesn't work very well. And
that's your prediction.
Let them go. let them go spend that money. And I'll keep.
But that's
paying.
an important part of the innovation cycle. If they don't do that, someone's got to fund it. So
listen, I push back on this stuff because I think like having a cleaning lady come to your apartment to clean or your house to clean like isn't that expensive right now, and I don't think it's like a bad process. So I think generally like technologists want to always deliver a technology solution to a problem, and I just don't think there's that much of a problem here. Now I do think there's probably, if the cost of the robot comes down to something, it has to be very, very low to replace the cost of unskilled human labor right now, because unskilled human labor is not very expensive for consumption. And I just wonder if that's the place where we work. Now, construction, I see tons of great use cases there. One, we're labor constrained, right? We don't have enough people who can do the skill.
Yeah.
Two, it's dangerous.
Yeah.
Three, it causes long-term health issues for people. One, loud workplace environments cause extreme hearing loss. Two, their bodies break down and hurt. Like it's never fun to see someone in their 50s and 60s who can't walk because their back hurts too much. So I think there's these really good use cases for robotics where we're like, hey, we should not be doing these things anymore. It's crazy. And we'll look back in 100 years like we do now with a bunch of other things and say like, I can't believe a person ever did that. That's crazy. Like
moving the piano from the 4th floor of a walk-up.
Totally.
That's going to be an act of mercy to have robots do that.
Right. And like, I can't think of it going on top of my head right now, but there are tons of these examples where like people used to do them. And now you're like, I can't believe a person used to ever do that. And by the way, I think driving will be that way too. Mm-hmm. Like, I don't think my kids will drive cars, or there will be hobby drivers who want to take their 2007 stick shift car out on the road and do it, or their 1970s car on the road and do it. But like, I don't believe that my kids will drive because I think they'll be like, that's really dangerous. I can't believe you ever drove a car.
I just rewatched iRobot, the Will Smith movie you referenced, and very prescient, good prediction. I mean, really incredible, to be honest, as a piece of content. I think the language they said was, stop driving with your hands.
Yeah.
In the movie.
Right.
Which was like a high risk way to drive.
It is a high risk way to drive.
Right.
Yeah. It's really crazy high risk. Right. People get distracted, and that's why we have accidents.
Mikey, thank you for your time.
My pleasure. See you again next year.
Phuong, 2025 in the rear view. You've got some predictions we got to talk about.
Yeah, let's do it. Let's see how right or wrong I was.
I think you did pretty well. Your first one was kind of on the nose.
Yeah.
You said tariffs will whipsaw consumer-focused companies. They'll have a roller coaster of a year.
Yeah, I think that was, basically a lob. It was a pretty general prediction that almost had 100% certainty, given what we knew at the end of last year. So yeah, they did have a roller coaster year. We saw, higher prices driven by tariffs and inflation. So even if, you checked your Amazon app, there's a lot of price upticks across all categories. I think businesses, especially small businesses, have seen dramatic increase in their costs. they're really suffering. So they've really had to reevaluate their supply chain and their sourcing, causing a lot of upheaval. I think on the other side, consumer spending, even though it was really strong throughout most of the year, surprisingly, we're seeing some dampening. So I think that's kind of pushing margin pressure across the board. So been a rough year for those guys.
Yeah, I remember there were moments earlier in the year where some business owners who were in e-commerce spaces were saying, yeah, we're pencils down. We don't know what our cost of goods are because they're coming from offshore. We're just not selling anything. Everything's off. We're waiting.
Yeah.
Then it got sorted out, but it was tenuous for sure. Crazy year.
Yeah, crazy. I think some of them are still trying to sort it out. You know, when you have these big bills coming from your inventory that are, you know, for the tariffs that you haven't paid yet, and it's more than the inventory cost itself, then it's a tough place to be.
Now, you also said there would be big leaps in the customer experience offered as a byproduct of AI and predictive analytics. Did you see any of that progress in 25? Was that
I think there was progress. I don't think that, I said that there was going to be this like hyper personalization. I don't think we got there yet. I think we got some stuff, AI driven customer service agents. Even that, like, I think the experience as a customer is not great, but I think for companies who are using them, these tools are solving more issues than humans ever did. So, that's been a plus, but I think it's not a seamless experience at all. We've had personalized product recommendations that are actually converting for companies. I think what is cool is that companies are starting to integrate their customer data across a lot of disparate systems, CRM, POS, loyalty. They're starting to build these 360 customer profiles that I don't think that they've taken full advantage of yet. And I think that that's going to really put things on hyperspeed, but it'll be, over the course of the next few years. It's not going to be, in a year.
I think that's the big takeaway is we can imagine where this might be going, but it's not getting there overnight.
Yes.
Right? Like the AI application layer, I would say very much in the first inning this year. Small use cases, not fully ubiquitous. It's still an LLM story. Application layer is kind of secondary. And I expect that to flip over the coming years. You also threw out AI adoption at home would accelerate narrowing the home versus work gap. So I guess it's like remote work tools would have been easier. AI would have made that a lot easier, was the concept there. I think you were just trying to be more remote. That's all it was.
What I was actually trying to say, Mark, but although, I do have my own reasons for saying this that are, for my own benefit, is that we are used to using a lot of AI in the workplace, for like, it's kind of like, my goal is to be more productive overall as an employee using AI. I don't view that as a goal in my personal life. And I kind of saw that, over that time period, over 2025, really having that gap narrowing. And I don't know, I wouldn't say that really happened. I don't know what I was smoking.
No, I think you're on to where it's going, right? Eventually, the main apps on your phone that aren't an LLM will eventually be heavily imbued or enabled or created because of AI.
Totally.
It's just not there yet. It's not
yet.
It's not mainstream consumer technology at this point. It's behind the scenes at best.
Yeah, I mean, you've seen some stuff where like your personal productivity tools, calendars, to-dos, emails, they become AI powered by default. But I mean, I don't know about you, but I'm always overriding mine.
Same.
And there's healthcare software that's been integrated with AI models for coaching, for diagnostics, for care navigation. We actually are currently working with a company called Care Atlas in our accelerator. And what their platform does is they're providing AI-driven human care to elderly patients in care deserts in rural areas. And they're making a huge impact on people's lives. But, it's not, I don't think that, I think that there are kind of disparate tools that are doing this. It's not kind of omnipresent in every aspect of people's lives.
Yeah, and that's a good example of a more robust use case of AI versus the calendar updating feature
Yeah,
that we're both trying to like turn off constantly,
right.
Where it becomes something where the AI is kind of unlocking a use case, a value, an experience that really wasn't there before in any way, shape, or form, even if manual.
Yeah, and I think the other thing to point out that it kind of illustrates the theme of AI, like right now, especially in people's personal lives, and also in the work life. It's not working by itself, right? It kind of is augmenting a human doing it. It's really making it's not ready, and I don't know if people are ready to even use it by itself, but it's really augmenting, in this case, the human care navigator to help them provide the services.
I can only imagine that in 3, 4, 5 years, we'll look back at this technological state and think it was a joke, right? It was
Yeah.
not rolled out yet. The promise has not been met yet, which is okay. Just pace of the journey. So, how about the startup landscape? I mean, you're living and breathing seed land. How are companies different at the seed stage in 25?
Yeah, I mean, I think that if you kind of think about it, I mean, even in the last year, we've seen a lot of change, but really since 2022, like we've started to see some of these changes. And I would say that, just to do like an overall, high level statement, I think companies are now smaller. They're like, especially at the seed stage, they're faster, they're more automated, and they're really focusing on different priorities versus a couple of years ago. They're much more focused on distribution way earlier, and then as well as being as capital efficiency. So let's just kind of like unpack that. I think that first thing around team size, pre 2023, 24, startups that have had raised were really hiring specialists for, if not almost every function. You're combining maybe 1 to 2 functions. So like you had a marketing person, and maybe that person did marketing and support, but you had an operations person, data, QA, design, you name it, like there was a different person for it. I think 2025 teams are a lot leaner, right? I think pre-seed companies often launch with just 2 to 4 people, and then kind of stay that way for a little bit. And that's possible because AI is taking over a lot of tasks: content creation, customer support, sales workflows. Uh, Founders can build products a lot faster with AI co-pilots. So then companies are able to just move faster. They're burning less. They can test more ideas before they make bigger commitments. And then secondly, I think that they're thinking about distribution of the product way earlier than they ever did before. Kind of like the old model was that the tech itself was a differentiator. You build a great product, you figure out how to sell it, and then you get people to sell it. The companies that I'm talking to now, they're talking about distribution from day one, right? They're thinking about designing products for workflows that people already use, integrating them with platforms that people already use, and then focusing on automation that spreads from the bottom up. So they're prioritizing adoption at the working team level so that products can grow organically. And then you're not having to spend money on these expensive sales teams.
The benefits of that are manifold, right? Not just are you keeping costs down, but you're getting to customer feedback cycles much quicker in the company's life cycle. So companies that can iterate can find product market fit so quickly now, whereas they used to have to wait 18 months just to kind of get to the race. They're in the
Yeah.
race like in a month or two now. When I first started in venture in 06, the first chunk of cost that people had to cover was the hardware, the servers. And then the cloud came out and the cost structure asymptotically dropped to the cost of the engineering team, right? There was engineering plus a handful of other folks, the business and ops folks.
Mm-hmm.
And now that's dropping to the cost of just a CTO,
Right.
or a 2 engineer team. It's so lean that it's a 10x decline, I think, in cost reduction.
Yeah, and I think that's great for founders. I think there's also the flip side to that, is that there's it's really hard to differentiate. yourselves, right? Because everyone else can do it just as fast as you can. So we can talk about that in a little bit. But overall, it's been a real plus.
So a handful of years ago, the big challenge faced by founders was they couldn't find enough labor. Well, now they don't need as many people. So what are the challenges that founders are facing today?
Yeah, I mean, I think labor still is a problem, and we can talk about that in a little bit. It's not the same type. It's not like finding enough people. It's finding the right people. I think that it's really about a mismatch between the roles that the founders really need and the talent that's available. So even though they don't need big teams, they need people who can work effectively with AI. They need engineers who can integrate rather than reinvent, marketers who can run AI powered content flows, ops people who can automate instead of manually execute. But I think the problem is these people are rare, right? I think most talent like on the market today, they're trained for the pre-AI world. So I think that's kind of one of the biggest labor challenges. And then that actually then makes it harder for founders because they don't know who to hire first. Before it was like a pretty clear playbook, depending on what kind of company you were. But now, because AI handles so much work, it's kind of unclear whether you hire a human or you automate. I mean, I think, we just even talked about this recently about, work at Interplay. And I think there's a risk of if you're new and you're early and you hire someone too quick, they might become obsolete. So that makes decision making like slower because you feel like every single hire is really critical. So I think that's from a labor perspective, what we're seeing is a challenge for founders these days.
Yeah, it's this weird transition period,
Yeah.
both in people leveling up and how do you look at the talent pool if you're in the hiring seat? Fascinating.
Yeah, for sure. And then I think there are also a lot of other pain points faced by founders. I think one of the biggest pain points, and I see this all the time because I sit in a lot of pitches. And one of the biggest ones is really like being able to stand out, right? Investors are always asking, what's your data advantage? Why won't this be commoditized? How are you different from your differentiators? Why can't someone else just stop? What stops someone from building this with the next iteration of ChatGPT? And I think a lot of times what I see is that founders struggle to articulate what their defensibility is. If it's at the early stages, like you probably don't have proprietary data, or if you have, it's. I think I find that to be rare. Is it domain expertise? Like, what is it? Because, and I think this is where what I was talking about before. The pressure has become so intense to differentiate because everything is so copyable, with AI.
Yeah, competitive dynamics were not brushed off pre-AI, but you could get away with a lot.
Yeah.
As an investor and an entrepreneur, because just starting a company was so damn hard.
Right.
Getting a team together, getting capital, not screwing the product up. As that bar has come down, oh boy, is competition a real consideration in a new way. So what do you see happening in 26? What's here's a way to frame it. What companies do you think what kind of companies do you think are gonna win in 26?
I think in 26, I think my first prediction in terms of, the winners, is that unlike 2025, where we saw the big winners to be companies that were automating individual tasks, I think the winners in 2026 are going to be automating workflows from start to finish. They're going to string together a bunch of tasks and be able to kind of, automate it end to end. And I think, also in that same vein of kind of taking what we're seeing now to the next level, I think the next wave of AI is going to really help people make smarter decisions. Right now you do need humans, and I think you will continue to, for the more judgment, nuanced decision making, which I think you will. But I think we're going to see some like AI tools being able to really help humans make smarter decisions. And thus turning automation into things that are really going to impact strategy creation, forecasting, things that are a little bit more nuanced. So think about, for example, a recruiting software where it creates the job descriptions, it posts it, it assesses applicants, it sets up the interviews, and maybe it even does, the first interview.
Right. And then on top of that, they're going to have to think about what you were saying before. How do they set up a barrier against competition? And maybe that's, integrating into deep parts of the organization to create switching costs. But there's going to be that additional dimension that people need to be paying attention to now in a way that they could have gotten away with not looking at in 5 years ago.
And a lot of times it's, really being what we saw from, our traditional B2B SaaS days is really having domain expertise and being, vertically focused on your verticals. I think that's going to help a lot of companies really focus on the customer and the output. But we'll see.
All right, flip this around. What kind of companies are going to fail in 26? Who's in the crosshairs?
Yeah. So I think kind of like in terms of traditional businesses of what companies I think are going to fail. In 2025, we saw AI again automating manual repeatable tasks. I think that in 2026, companies that produce manual repeatable work are really at risk unless they pivot to higher value offerings. That and specifically, examples would be like traditional content and media companies. Generative AI now can produce really high quality text, audio, and video. And so I think that, companies that were, writing agencies or small content studios that were creating kind of run of the mill content, they're really going to suffer. I mean, I used to work for a media brand. I ran a part of my job was running a team of 15 writers who wrote affiliate marketing pieces. I couldn't imagine, managing a team like that right now. Other examples, customer support and outsourcing. Again, we spoke earlier about the AI chatbots and virtual agents that are doing such a great job and will continue to get better. Routine legal services, Harvey AI is doing really well right now in terms of kind of doing those basic contract reviews, due diligence, research. So I think we got to keep an eye on those guys. Those guys need to think about what their next steps are.
How about tips for watch outs or things that are dangerous for the innovative companies, the tech companies coming out in 26?
Yeah. I mean, I think that, I think in the next year, AI startups really need to watch out. Like, I think a lot of them are going to lose for three main reasons. And they need to really, kind of keep an eye on areas of kind of overestimating how people will actually use their AI. I think that's, and it's hard to tell because it's really about understanding people's behaviors and how much their behavior is going to change, like how much people are willing to change their behaviors. I think, AI startups are going to lose because they make people's jobs easier, but they don't really move the needle or impact KPIs. So think about, some of the tools that are available that actually don't really change, that they make your job easier, but they don't really change outcomes. So for example, AI calendar scheduling assistants might save you 5 to 10 minutes a day, but is it impacting anything from a KPI perspective? Users might use them, they might appreciate them, they rarely pay for them, and they rarely stick with them. And then I think the last watch out for companies is that, be prepared or, do some planning. Cause I think some companies with amazing products might find themselves obsolete because their functionality ends up being baked into bigger platforms. So for example, AI-driven transcription or translation products that have done well thus far may not, as Microsoft or Google puts transcription like directly into their own products. And so I think that's something that we're all always asking ourselves. when we're looking at companies that have pitched us is that, okay, well, what if a big guy just launches it as a feature already on their platform that people are already using? What happens? So really being able to anticipate the market and whether or not, you're going to be swallowed up by one of these big players. So
the thing you said at the beginning there about unexpectedly slow adoption, that was a hard lesson we learned in a bunch of our B2B SaaS plays in the prior generation. Industries we found that were slow to adopt technology generally, like literally the stereotype, hey, they're still using a fax machine, what the hell? They would not buy software that would triple productivity because they just didn't care. They weren't trying to be productive. So there was a mindset that was underlying creating a barrier to adoption of new tech.
yeah,
And so that may apply with new AI whiz-bang tool sets, right? Where, you still got a mountain to climb over just to get the adoption going because the customer doesn't care. Maybe they're checked out, they're close to retiring. It's an older set in the customer segment. So those are all factors to really look into. And I would say the lesson learned for us was the more we thought the customer was likely to adopt new technology, the faster they adopted technology. As obvious as that sounds, what it meant was closing the holes in the market where you couldn't believe they weren't doing it already. Usually that was a little bit of a red alert that they weren't going to do it quickly if you showed up with the right product. So a little bit of a learning there that may still apply. Now, that doesn't mean if you come out with something truly disruptive that removes those people from the equation, it can't work. But if you're selling to them, you might find it hard to get their blessing.
Yeah, and I think that's where some of the methods that we use in in the old school ways of building a business are really even more important now, right? Really testing and iterating, getting into the minds of your customers, talking to customers, having them use your product, getting that feedback to build, to validate and build out additional features. I think all of those are going to be really even more important now than ever.
This is awesome, Phuong. Thank you so much for doing this.
All right, thanks. Happy holidays.
Huge thank you to Mike and Phuong. What a joy to be working with both of them. And they're so good at what they do. So huge gratitude just from a day-to-day and also this pod. And with that, we're going to wrap up 2025. If we can be helpful at Interplay, we're easy to find. Just find us at interplay.vc and we'll catch you next year.